Today, Three Arrows Capital defaults on a $600 million loan. Goldman Sachs says it's time to sell Coinbase stock. And tech leaders discuss crypto winter, stablecoin regulation, and a whole lot more at the Aspen Ideas Festival. Welcome to CNBC's Crypto World. I'm Pippa Stevens. Digital asset prices remained steady over the weekend, but they are falling once again today. By noon Eastern, Bitcoin dropped below $21,000, Ethereum dipped below $1,200, and Solana fell to around $38. Okay, on to the top stories. First up, Three Arrows Capital just defaulted on a loan worth more than $600 million. The hedge fund failed to make a payment on the more than 15,000 Bitcoin and $350 million in USDC lent by crypto brokerage Voyager Digital. Voyager said it would take the necessary steps to recover those funds. The company's CEO said it was working to strengthen its own balance sheet in the wake of the crypto crash. Next, the downturn in digital assets is also hitting crypto-focused stocks. Goldman Sachs warned investors to sell shares of Coinbase, mainly because of the steep drop-off in trading activity for digital assets. The investment bank said that declining investor interest in crypto means Coinbase could lose significant revenue. In fact, Goldman says that by the end of 2022, Coinbase's revenue could fall 61% from a year prior and drag the company's stock down with it. And speaking of falling prices, Morgan Stanley says Ethereum's merge could cause demand for graphics cards to plummet. Ethereum's transition to proof of stake means miners won't need much of the processing power that they currently have. They'll stop buying new GPUs and potentially sell the ones they already have. Now, prices for graphics cards had surged in recent years as more miners came online. But Morgan Stanley says that sudden drop in demand for these components could lead to a correction in prices for GPUs. Okay, for our main story today, CNBC is at the Aspen Ideas Festival in Colorado. We spoke to Brian Brooks of Bitfury and Brooks Entwistle of Ripple. They came together to discuss the use case for crypto and, importantly, whether or not the technology is here to stay. They also addressed the recent crypto crash and what it means for the technology.
Because it has been a very difficult couple of months across the sector, and that's obviously not just in the US, but from a global perspective as well, as we'll talk about on this panel. One of the things that Brian and I will both talk about is this is not the first time this has happened in this industry. This has been a reasonably regular occurrence over the life of digital assets and crypto the last decade plus. And one of the elements that I think we've learned over time is that winter time is actually a fabulous time to build businesses and to really define use cases for digital assets and crypto. And I think in some ways take a little bit of the fluff out in some of the business models that may not have a long-term nature to them as well. So it is deep. We're not in the consumer-facing trading business, so we're not in the business of making calls on one coin versus the other. I'm certainly not going to do that today. But we do gather here at a very interesting time and pivot point for the industry.
The panel also addressed the infrastructure and dismissed the idea that crypto is here to replace the US dollar outright.
You know, the biggest issue that I always try and focus on is cryptocurrencies are really not about currency. And the biggest misunderstanding of this whole discussion is the belief that if crypto is not doing a great job of replacing the US dollar, then crypto is failing in its mission. And what I think we'll talk about a little bit today is the idea that most of crypto is about replacing the centralized banking system with networks that allow user control versus bank CEO control. The crypto assets that have prices are more like internet stocks. It's more like you bet on Google if you think there's going to be high internet traffic, and you short Google if you think people are going to go back to the post office, right? But it's not that Ethereum or Ripple or anything else is trying to replace the US dollar. It's trying to replace a system of transmitting value. And we'll talk a lot more about that. So for me, the prices are not that relevant any more than Google's volatility is. And in the early days of Google, that was super volatile.
U.S. regulation was, of course, a topic of discussion as well. And Entwistle pointed out that regulation and which agency enforces it really depends on the use case for the cryptocurrency.
I think one of the key things in talking to Washington or Singapore or Dubai or the Swiss regulators is drilling down on exactly what each of these use cases are for and what they do importantly for citizens or their constituents in that country. And I do think one point that's very clear is we've talked only about 3 or 4 tokens here. We may get down the long tail a couple more, but the reality is that you're not going to spend a lot of time today discussing some of these more esoteric cryptos that have come and gone for good reason, because the utility use case wasn't there or may not be there. They may be solutions looking for a problem, which you have a lot of in this industry. But I do think that this notion of whether or not it's stored value or building on Ethereum as it relates to financial services or anything around NFTs, which I know is a topic later at Aspen Ideas, or if you're really going after this movement of value across borders, which happens to be the one issue that Ripple has been after from the beginning, that is actually a real use case, and governments will sit up and listen because that matters.
Then there are the stablecoins, which are of particular concern for lawmakers after the collapse of Terra USD.
Stablecoins are actually the tip of the spear on crypto regulation, and it's the one area where I think there is weirdly a really strong bipartisan consensus. I mean, there's not a lot of that in the world today, so man, bipartisan consensus on anything is a good thing. So this gets to Brooks's point about disclosure. When I was the controller, I signed the first regulatory guidance that defined what a stablecoin was that would be allowed inside the US banking system. And what I said was that a stablecoin, to be in the banking system, has to have three features, okay? First, it has to be backed by risk-free assets, meaning it cannot be backed by junk bonds, long-dated corporate securities, or whatever. You know, I used to joke that one of the popular stablecoin projects was backed by 68% bank deposits, 12% partially hydrogenated vegetable oil, and a set of other things. Right? That's not a stablecoin. It has to be backed by risk-free assets, meaning insured bank deposits and short-term treasuries and nothing else. Second, it had to be redeemable on demand and at par. So if you meet those three conditions, in other words, if you really are a traveler's check, except you're operating over the internet, you're a stablecoin. And that is what Secretary Yellen has basically figured out, I think, in the statements that the Treasury Department and others have made about stablecoins today. So I think that's going to be a good thing. Why do you care, though, Elon? That's the more interesting thing. You should care because in the future, stablecoins will become what people think of bank deposits today. And the difference will be, especially for lower income Americans and people, these will be bank deposits that don't have a minimum balance fee, don't have a monthly maintenance fee, don't have a transaction fee. That is why stablecoins are things that you will hear a lot about in the future, even if you're hearing about it for the first time today.
All right, before we go, CNBC also caught up with Snoop Dogg at NFT NYC last week, and here's what he said about the world of music and its involvement in NFTs.
Sooner or later, the label's gonna have to come on in. And they're gonna have to come on home and they're gonna have to sit at the table and understand that, you know, their catalogs and things that they hold on to are better served on the blockchain than sitting in the catalog collecting cobwebs.
Okay, that's all for today, but we are back again tomorrow and we'll see you then.